The following podcast was recorded on Thursday, April 22nd, 2021, featuring Ben Breitholtz and Anthony Rizzo of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh with Arbor Research and Trading. Today I'm joined by Ben Breitholtz and Anthony Rizzo of Arbor Data Science. Welcome to both of you. Today we're going to be walking through central bank natural language processing, and the two of you have done a lot of work on this topic and you've got some good charts to show us. So let's get started and kind of walk us through each chart. Can you tell us or give us your overview of the data and the process that you use in Distilling officials' communications?
Yes. So Anthony and I, Anthony is new to the podcast and new to Arbor, so welcome, Anthony.
Thank you.
And what we have always done is attempted over the past number of years to really try to get a firm handle on central bank communications and how that relates to policy that will unfold over the next weeks, months, quarters, years. And the beauty is that given Powell and the new kind of clear-cut direct communications, that's opened itself up really well to using natural language processing to get a flavor for kind of the nuggets of information that we need to determine their expectations for inflation. How concerned are they worried about it? When are they going to taper? When will they ultimately hike rates? And so on. And the neat thing too is we can do this worldwide. So we have this huge repository of data, and I'll turn over here for Anthony to talk about that. But we have, what, 17,000 plus speeches that we're now aggregating from across the globe. Give us more context on that.
Yeah, that's about right. I think there's almost 17,000. There's something like, though there's over 100 central banks that we collect from. Then once we have that, we're able to just get the text of the speech, and we use like a lexicon system. We found that works best since central bank communications tend to use different language, say like social media or news.
Yeah, and that's exactly it. So the key there is we've done a lot of fancy analytics and machine learning, even run things like RNNs in order to extrapolate sentiment, but we always come back to this lexicon dictionary-based approach. It means we're essentially looking for frequencies of given terms, phrases, and so on that are spoken on a per speech basis relative to what we determine to be the high frequency, the list of words and phrases. And the beauty about that is it's simple, and it doesn't have to get into anything too fancy in terms of modeling. We're able to rely on these frequencies quite well to then estimate where we think what this means essentially for central bank policy over the weeks and months to come. So as Anthony said, a large amount of speeches and spanning 100 plus central banks, something that we've kind of started to do away from just focusing on the bread and butter ECB and Fed.
And we've got a couple of your charts I'd like to bring up just so we can show everyone, especially in regards to, you mentioned inflation being brought up in speeches. So that's our first one here. Any commentary, any comments on this one?
Yeah, so the key here is that inflation as a general topic has really fallen away, and it obviously is something that was habitually important and focused upon. But in this age of bringing employment back to hopefully full employment, removing the slack, central banks have considerably decreased their focus on inflation. Asia Pacific and the ECB are actually even lagging the U.S. and the Federal Reserve in relation to how much they're talking about inflation. And as we all know, the word of the year is transitory, and really the belief that this bout of inflation that we've begun to see initially in surveys, ISM surveys, then in PPI, maybe starting to show up now in flexible components of CPI. The big question is, will that continue? And for now, central banks are clearly indicating that they are not concerned about the inflation outlook. And in fact, they're actually somewhat cheering it along.
So we'll go ahead and just kind of scroll through here. We've got a couple more slides that illustrate that point with the next one. We're going to scroll down here. We get all the way up to financial stability.
Yes, so financial stability is is something that became front and center in March following really the onset of the pandemic, and we had the major dislocations, liquidity issues that arise even the most liquid of assets, which was treasuries, and that threw everybody for a loop. And central banks became heavily fixated on that. That's how we ended up getting, overt amount of buying out of the Federal Reserve, and along with other central banks and the SMCCF programs and others that were instituted on March 23rd. But what we've noticed over the past number of months is that the focus on financial stability and liquidity within the system and volatility in general across risk assets has tumbled. And that's led by the Federal Reserve. So this Federal Reserve is really taking this approach based on their language of not being overtly concerned with valuations, the prospect of inflation becoming disruptive, liquidity concerns. All of that has become incredibly dampened. Now, the big wrinkle there is that not all central banks are the same. And I believe, Anthony, the data shows that the ECB's focus, which I think is the next chart we have in the packet, the ECB's focus on financial stability is actually higher, and same as Asia Pacific, than the Federal Reserve. Is that correct?
Yeah, that's correct. There's a lot of reasons this could be. The ECB may have more investor pressure to address this, have to talk about it more. And this applies to Asia Pacific as well, with a lot of the emerging economies, as well as Australia, New Zealand, places like that.
Yeah, I think that's definitely the case. And we saw that today. So as we're recording this morning, Christine Lagarde ended up having had her press conference, and there was a lot of concern about the amount of PEP purchases. As you know, they've increased those from 14 billion to 17 billion per week, and they've been coming in lower than expected. And a lot of individuals are kind of indicating this was a communication error. And so I think that is emblematic of how important the central bank communications from the ECB is in calming investors' nerves, and also how much the ECB and really Eurozone investors are reliant on a continued accommodative ECB. And again, this kind of natural language processing shows that, again, with the Fed that's not as concerned with financial stability, while the ECB certainly is. And again, that means that reaction function to these communications is even that much more heightened, and makes them, these speeches, maybe from the ECB, the most important really across the globe at the moment.
One topic that we want to be sure and touch on today is a very hot topic, and we've got a couple slides to show here, is in regards to the central bank, what are their views on cryptocurrency?
Yeah, well, it's definitely become more popular over time, especially after like the initial spike of Bitcoin at the end of 2017. Looking at the chart, you can see the amount they address it goes way up. It's sort of tapered off in the last year, probably because central bank focus was elsewhere with the pandemic and recession, people losing their jobs, stuff like that.
But also then on the next charts, what Anthony was able to show, and he put all this work together, is that the interest based on each central bank. Again, we have over 100 central banks that we're targeting, and here you've aggregated them kind of by some regions, then also put in the big boys. But I mean, the most impactful thing is potentially that the US, the Federal Reserve, is the least interested, or at least giving the least amount of time to cryptocurrency than other locations. So what locations are showing the most interest?
Yeah, I just want to note really quick that though the Fed isn't the smallest on the chart, they do have like way more speeches than many of these other regions. There's something like 2,500 Fed speeches compared to like a few hundred in South America, for example. So the actual proportion of time that the Fed spends talking about this is significantly lower in some cases.
But then the places they are would be, Africa. I think Mauritius was an odd location that had an incredible number of speeches. And then throughout Asia Pacific. Again, this gets back to the issue that the US and the Federal Reserve, given having the preeminent fiat currency, is the most willing to abstain from communications about cryptocurrency, while areas that are already so heavily using cell phones and so on for commerce in Africa and portions of East Asia have shown a substantially higher degree of interest in cryptocurrency. And so it's going to be worth watching how this balances out going forward. Do we see a convergence with the Federal Reserve becoming more interested? Does that give more legitimacy to cryptocurrency? Or is this something that's really going to develop, as our colleague Jim Bianco has said, outside of the US? And decentralized finance is something that's picked up outside of our walls due to concerns, regulations, and the lack of focus. So that's a big question. And that gets to the legitimacy, too, of cryptocurrency. One chart we have is from the television news archive discussing how legitimate is it from a gambling versus investment perspective. If you could take us through that quick.
Yeah, so what I wanted to do is measure sort of over time how often the news would describe cryptocurrency as more of a gamble and more of a legitimate investment. So the positive axis, or the positive, if the graph's positive, that would be more of an investment sentiment. And recently that's just shot up incredibly. It definitely.
And do you expect it to stay that high at that level?
If the public continues to adopt it, I would say, yeah.
And that's the big thing. So if you look back at this chart, which is wild, in 2017, 2018, we saw nothing but poo-pooing of cryptocurrency and Bitcoin, the biggest fraud of all time. And then, of course, in late 2019, it started to catch a little fire, and then, of course, lost out due to the pandemic. But as of late, given all these billionaires, Musk, and the lot, Mark Cuban and others adopting, even getting wild things like Dogecoin to rally exponentially. But the financial media and the general media, there's no doubt, have started to talk about it more as a true investment, as well as a means of actual currency, as opposed to a complete gamble. So the more that continues, the more there'll be on pressure on central banks. And I think that's the thing we need to watch. How much is the Federal Reserve discussing this as something that's legitimate versus all these other central banks that seem to be more hip to the concept?
And let's end today by, again, talking about the Federal Reserve. Are they going to stick to their guns over a transitory approach to inflation?
Yeah, they sure seem to be. And I think, Kristen, last time we were talking with Jim Bianco, our colleague, we were kind of joking about how Powell's recent open letter kind of walked back a little bit on the transitory discussions and on the idea that they'd let inflation run hot and be stable above 2.5%, 3% for a number of months. And some officials seem to be saying, we don't want to see it persist for 6+ months above that 2.5% to 3% threshold. But what we can do there is we can measure, let's see how much are they focused on this transitory, temporary, short-lived style of communications. And there's no doubt that that has risen appreciably and on par with levels that we saw, for example, back in 2011, which is kind of the last time we had some of an inflation scare that the Fed proved right in that dubbing it somewhat transitory. The same thing happened 2015-16 on the opposite side when inflation became so dastardly low thanks to crude oil. But the chart here shows the amount of allocation to these topics: idiosyncratic, short-lived, temporary, transient, and so on. And that's something that's becoming quite embellished and consistent across officials. That's also leading to a high degree of passiveness from the central banks too, and that they've kind of converted to this result-based approach. So on the next chart, we talk about how we show how passive and how willing to wait essentially the committee has become, in that they're using words like wait. Some time has become Brainer's and Clarita's and Powell's kind of favorite word or set of words. And this passiveness means that, again, they're results-based. They're going to wait for the realized data to hit them in the face before they actually make any changes to policy. The one wrinkle, which I think is in the next chart, has to do with the essentially with not necessarily the passivity or the transient nature of their discussions, but has to do with the agreement. And so one thing we've seen as of late is the level of agreement among officials. So how often they're saying they agree, they're giving each other high fives, smiles, whatever it may be. That's actually plummeted over the past maybe 4 to 8 weeks. Now it's on par with levels we saw coming out of the taper tantrum, when there was a lower degree of agreement due to the financial stress that was incurred with rising interest rates. But what we want to do is we're looking at 3 measures very closely, and I think these will be very telling and predictive of what when the Federal Reserve will finally take their foot off the gas. And that's, again, we want to see the transitory type comments fall considerably. We want to see the passive style comments fall considerably. And we want those to match the lack of agreement that we've begun to see. So out of those three things, we've seen one already happen, meaning the degree of agreement across officials is substantially lower than it was coming into this whole adoption of average inflation targeting. So we get those other two to drop. I think that's going to be what is going to be the leading indicator of the Fed finally tapering, which we think could happen as early as the first months of 2022. So summing this all up, we take all this fancy natural language processing and we predict where we think shadow rates, essentially the rates, the target rates accounting for central bank purchases, be it PEP purchases by the ECB or by the Federal Reserve in terms of traditional QE. And what we expect there is for the Federal Reserve's target rate, shadow rate, to come all the way back to 0 basis points after being well below, negative 200 basis points or so, while we expect the ECB's to remain quite stable below negative 200 basis points. That means we'll have this substantial gap, somewhere around 150 to 200 basis points between the two, which is bullish, for example, from the dollar. That's why we turned bullish on the dollar to start this year. Now we've seen a bit of a setback, but we think that this trend, this expectation for shadow rates will be a driving force, particularly in relation to not just their spreads on a sovereign basis, but also in the currency space. And so that's, I think, again, something that's a must watch as well.
Well, thank you both for your thoughts today. Any final comments as we wrap this up?
Yeah, as we said, I think the beauty of the style of communications from the central banks right now, how crystal clear they're attempting to be, lends itself very well to natural language processing. And that has us focusing heavily on these new words that they've adopted, which have to do with the degree of passiveness, and then also the degree of agreement, and then how patient they are really in this process. And once we see some of that shift and they become less patient, and they've already started to see less agreement, that's when we start to believe the taper is on the horizon. Now, the ECB with Lagarde today said that's not happening anytime soon. They committed to March 2022 to keep purchasing. And if that remains the case, there's going to be divergences here in central banks. I mean, heck, we already saw the Bank of Canada began to taper. And this is when things get exciting for investors finally in the sovereign bond front.
Well, thank you, Ben. Thank you, Anthony. And thank you, everyone, for joining us today. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. For any questions or further information, please contact Gus Handler at gus.handler@arborresearch.com.